Silver just flashed a stress signal that only shows up when the physical market is winning, even while the headline price tries to hypnotize you into thinking the danger is past. And if you own gold and silver, you need to understand one hidden mechanism because it tells you what the next 1 to 2 weeks could look like, what level matters, and what breaks if that level gives way. The loud story right now is simple. Silver ripped, it got slapped, and everyone's arguing about whether that was the top. But the quiet story is different. The quiet story is the curve, the spreads, the delivery incentives, the way liquidity thins at the exact moments people feel most confident, and the way margin rules can manufacture calm by forcing one side to puke risk no matter what they believe. That is why this is a $500 silver alert without the cartoon promise that you waking up tomorrow to triple digits. It's an alert about regime change. It is an alert about how a market transitions from tradable to untradeable at the margins. And it's an alert about the kind of reflexive feedback loop that, once it starts, makes prices move in chunks instead of steps. Stay with me, because later in this video, I'm going to give you a clean checklist for the next week or two, a 2-scenario map that keeps you from getting emotionally played, and the one underappreciated detail that separates a spike from a structural squeeze. Here's the conflict that matters. The system wants you focused on the screen price, because the screen price is the easiest thing to manage with liquidity, leverage, and narrative. But silver isn't just a screen market. Silver is a hybrid market where the paper layer can dominate the day-to-day print, while the physical layer silently tightens the noose through delivery constraints, refining bottlenecks and procurement behavior. And when those layers diverge, you get the same movie every time. First, price climbs, and everybody calls it speculation. Then volatility explodes, and weak hands get punished on both sides. Then you get a violent drop that feels like proof that the move was fake. And right when people stop watching, the underlying tension either resolves quietly or it detonates. And that's where the real pressure starts. So let's talk about why the move got slapped, because this is where most investors get tricked into the wrong conclusion. Markets do not change their mind in one day. They reprice risk because something forced them to. One of the biggest forces is margin and financing. Futures markets are built on leverage, and leverage is a privilege with conditions. When volatility rises, exchanges and brokers raise margin requirements and tighten risk controls. That's not conspiracy. That's basic survival for the clearing system. But the consequence is brutal. A margin hike is like suddenly increasing the monthly payment on every leveraged position at the worst possible moment. Some participants can pay, some can't. And the ones who can't don't get to hold their opinion. They sell, now, into thin liquidity. Even if they're right, even if the physical market is tight, even if the fundamental story is improving, margin doesn't care. That's why you can see a market that is structurally stressed underneath and still watch the headline price fall like a stone. The selling is mechanical. It's not a vote, it's a liquidation. And when you see that, the correct question is not did the story die? The correct question is, did the forced sellers finish? Because if they didn't, you're still in the danger zone. But if they did, and the underlying tightness is real, the next leg can be sharper than the first, because the float is now in stronger hands. But that's not the part that matters. The part that matters is the hidden detail almost nobody explains clearly. Not all silver is the same in the only way that counts during stress, which is deliverability. In warehouse systems and exchange ecosystems, you'll often hear language that boils down to 2 buckets. There's metal that exists somewhere, and there's metal that is immediately deliverable into the specific system that settles the contracts. In other words, there's silver that is in the building, and there's silver that is on the loading dock with the paperwork stamped and ready to ship. In calm markets, people blur that distinction because it doesn't matter much. In stressed markets, that distinction becomes the entire market, because you can have plenty of metal in the world and still have a shortage of deliverable metal at the point of settlement. You can have supply in one region and demand in another, separated by refining, logistics, and time. You can have silver sitting as byproduct production in concentrates that need processing, while the market needs specific bars in specific locations. And when that happens, paper price can look reasonable, right up until someone needs delivery and discovers that the reasonable price is not actually clearing the real market. That's when spreads start screaming. That's when the curve becomes a lie detector. And that's the detail that reframes everything. Now, let's ground this in the reality you're feeling right now. Silver has been violent. It surged to levels that woke up the entire metals complex and pulled in momentum money, and then it snapped back hard enough to convince a lot of people that the whole thing was a mirage. The range you're seeing now is not random. Ranges, after spikes, are traps. They're designed by market structure, not by some villain, but by the natural incentives of dealers, funds, and anyone managing risk. When volatility is high, liquidity providers widen spreads. Dealers hedge more aggressively, funds reduce exposure, and the market becomes jumpier, faster, meaner. That's why you can get repeated fakeouts in both directions. The range becomes an extraction device for emotions. Bulls get euphoric on every push-up, then panicked on every flush. Bears get confident on every dump, then terrified on every rebound. If you don't name that dynamic, you will be the fuel. And you already know this because you felt it. Your brain wants to anchor to a number and feel safe. The market wants you reactive. The market wants you chasing confirmation. That's where the real pressure starts. So why now? Why this week? Why this month? Why does the calendar matter? Because early January is one of those windows where liquidity and positioning don't line up with fundamentals. You've got fresh allocations, fresh risk budgets, and a lot of managers who just turn the page and are willing to express new themes. You also have the leftover effects of year-end positioning, where certain players reduced exposure for optics, for balance sheet reasons, or simply to survive volatility into the close. Then you layer on thin liquidity. When liquidity is thin, price discovery gets brittle. It doesn't take much to move markets, and it doesn't take much to create gaps. That's why you see outsized moves around weekends, around early week opens, and around the first full trading weeks of the year. Add to that the fact that commodities have delivery cycles, roll cycles, option expiries, and calendar deadlines that force real decisions. When you hear someone say, nothing changed, but the market moved anyway, the answer is often, something changed in the calendar. And this is one of those periods, because if this one level breaks, the math changes. Now let's open the hood and talk about the curve, because this is where you earn your edge as a retail investor who refuses to be emotionally managed. Spot price is a headline. Futures structure is information. In a healthy, well-supplied market with normal financing conditions, you typically see a curve where later months trade above near months. That's contango, and it reflects storage costs, financing, and the convenience of time. But when the market is stressed and nearby demand is urgent, you can see the near months bid up relative to later months. That's backwardation, or at least a tightening of spreads. You can also see the nearby spread get jumpy, spiking when someone needs metal now. This matters because it's harder to fake. It's not impossible to influence, but it's anchored to real incentives. If people can buy spot and carry it forward easily, the spread won't stay tight. Arbitrage will crush it. But if the spread remains tight, it ends often because the carry trade is in T, as easy as the textbook says, either because metal is hard to source in the right form, financing is expensive, logistics are constrained, or someone is paying up for immediacy. Translation: the screen price might be wobbling, but the underlying system is whispering, there's a problem. And that whisper is what you watch when the headlines are loud. Now stack the proof, because you should never rely on one argument in a market like silver. Proof point one is supply chain reality, especially refined supply and bottlenecks. Silver is mined, but a meaningful portion of silver supply is byproduct. That means you don't get to turn on silver production just because silver price jumps. If the base metal cycle slows, byproduct supply can tighten even if silver price is screaming. Then you add refining and fabrication. Concentrates don't magically become deliverable bars overnight. There are lead times, there are capacity constraints, there are regulatory and logistics frictions. And when the market suddenly demands specific forms of metal, those bottlenecks matter more than headline production numbers. That's where the real pressure starts. Proof point two is policy and trade flow risk, because metals are not just geology, they are geopolitics. When major industrial players adjust export controls, environmental rules, or licensing regimes in the broader metal supply chain, you can get ripple effects that show up first in availability and premiums, not in the spot chart. Even if the policy isn't about silver, it can hit the machinery around metals, refining inputs, critical materials, industrial components, and the broader flow of commodities that share infrastructure. In a world where supply chains are already sensitive, small policy changes can create big marginal stress. And silver lives on the margin, because silver AS market is not as deep as some people assume when they stare at paper volume. The physical market is smaller, and that means when it tightens fast. Proof point three is geography. You don't need the entire world to run out of silver for a squeeze dynamic to appear. You just need metal to be in the wrong place, in the wrong form, at the wrong time. London can look stable while another hub tightens. One region can have bars, while another region needs refined product or specific delivery specs. The arbitrage that should fix it can be slowed by time, cost, and paperwork. That's why the most serious signals can be boring. It might look like increased borrowing costs for metal. It might look like higher premiums for certain products. It might look like unusual drawdowns in specific inventories, even if total inventories don't collapse. It might look like delivery interest becoming sticky instead of rolling away. These are not flashy, but they are the breadcrumbs the market leaves before it moves in a way that surprises everyone. But that's not the part that matters. Proof point 4 is institutional plumbing, and this is where people get emotional because they want a simple villain. Don't do that. Focus on incentives. ETFs and ETPs can act like pressure valves between investment demand and physical metal. When money flows in, authorized participants create shares by sourcing metal and delivering it into the trust, then selling shares. When money flows out, shares are redeemed and metal can be released back into the market. In a calm market, this mechanism helps keep things aligned. In a stressed market, it can amplify the squeeze or the release depending on timing and sourcing conditions. If investment demand surges when sourcing is hard, the ETF mechanism can become a focal point for physical demand. If investment demand fades during a margin-driven liquidation, ETF outflows can release metal and ease stress. Either way, those flows are not sentiment. They are mechanical connections between paper and physical. That's why you watch them. Not to worship them, but to understand who is being forced to do what. Proof point 5 is the options layer, the reflexive machine that can turn a normal rally into a launch. Here's the simplified version without the jargon. When people buy call options, the dealers who sell those calls often hedge by buying the underlying or futures. The more price moves up, the more they need to buy to stay hedged if the market is in a certain gamma configuration. That creates forced buying into strength. It's not bullishness, it's hedging. Then when price snaps back down and volatility spikes, the hedging can flip and you get forced selling into weakness. That's why silver can feel like it's possessed. It's not possessed, it's structured. And when implied volatility rises, option pricing changes, hedging intensity changes, and the market becomes more reflexive. It starts feeding itself. That's where the real pressure starts. Now let's address the counterpoint head on, because you need it for credibility and for risk management. A lot of smart people look at silver spikes and say, this is a bubble, and they're not crazy. Silver is notoriously prone to speculative surges. It attracts leverage. It attracts narrative traders. It attracts people who confuse conviction with position sizing. And the chart history is full of episodes where silver rips faces off and then punishes late longs brutally. So yes, the bubble argument exists. High volatility, crowded positioning, headline-driven flows, and a market that can reverse hard because it's thin at the margins. If you ignore that, you become a victim of it. But here's the rebuttal that matters. Bubbles pop when supply responds, when demand exhausts, or when the system can smoothly absorb the flows without friction. A structural squeeze dynamic is different. A structural squeeze dynamic is when the system can dig tea smoothly supply the deliverable stuff, even if price signals it should. And when that happens, you can get multiple waves, rally, crash, consolidation, then another rally that surprises even the believers. Because the first wave doesn't solve the problem, it just reveals it. Now tie in gold, because if you own gold, you're already involved whether you admit it or not. Gold sets the macro tone for the complex. Gold is the balance sheet asset, the reserve asset. The one central banks and sovereign actors can actually move in size without needing a story about industrial demand. When gold holds firm in the face of tightening financial conditions, that tells you there's a bid under the surface for monetary insurance. When gold trends higher, it creates psychological permission for investors to own metals again. And when gold is stable, silver can express the higher beta version of the same theme. But silver also has an industrial heartbeat. That's why silver can outperform dramatically in certain windows and underperform brutally in others. If gold is holding in the low to mid 2000s and refusing to break down despite yield noise and dollar noise, that's an environment where silver's upside tails stay alive. If gold rolls over hard and breaks key supports, silver's air pockets get deeper. This is why you don't watch silver in isolation. Watch gold as the anchor and silver as the amplifier. But that's not the part that matters. The part that matters is what you do with this information right now, this week, this month. Because you're not here for philosophy. You're here for a map. So here's the map. And it's built around levels, structure, and the behavior of the underlying signals, not your feelings. First, identify the recent spike high zone. In silver's case, think of the psychological round number area near where the last surge topped out, the region that headlines remember. That zone becomes resistance until proven otherwise. If silver can reclaim that zone on rising volume and, more importantly, on stable or tightening nearby spreads, that's a sign the move is not just paper froth. If it repeatedly fails there and the curve loosens, that's your first warning that the physical stress is easing or that paper is back in control. Second, identify the post-spike low zone, the level where the liquidation finally found buyers. That's your line in the sand for the near-term thesis. If price chops above it and keeps defending it even during ugly intraday swings, that tells you forced selling is being absorbed. If price slices through it cleanly and stays below, especially if gold is also weakening, that tells you the market is still in deleveraging mode. You should respect the downside tails, because if this one level breaks, the math changes. Third, watch volatility behavior. Not just high or low, but whether volatility spikes are being sold back down or whether they keep building. In a healthy continuation, You often see volatility surge on breakout, then compress as price grinds higher, then surge again on another expansion. In a sick market, volatility stays bid while price bleeds, which tells you hedging demand and fear are persistent. Persistent volatility means bigger gaps, bigger stop hunts, and bigger emotional manipulation. You need to expect it rather than be shocked by it. Fourth, watch the curve and the spreads like a hawk. If nearby spreads stay tight or get tighter while spot is chopping, that's a tell. It means the market is still paying for immediacy. It means the physical layer hasn't fully relaxed. If spreads loosen meaningfully, that's a sign the system is rebalancing and the urgency premium is fading. Not bearish forever, but it changes the near-term setup. And this is where you get the payoff I promised. If spreads tighten into a reclaim of the recent high zone, the probability of a continuation burst rises sharply because the hedging and delivery incentives align. If spreads loosen while price struggles, you're more likely in a long, grinding reset. Fifth, watch institutional flow proxies without worshiping them. If broad silver vehicles show steady net demand while price is volatile, that suggests investors are using the dip to accumulate, not to exit. If you see sharp outflows on down days, that can create additional supply and extend the reset. Again, mechanical, not moral. The market doesn't care what you think, it cares what participants are forced to do. Now let's talk about targets and timelines in a way that doesn't insult your intelligence. The $500 number is not a price target in the normal sense. It nests a signal flare for the kind of convexity that exists if the market transitions from a paper-led regime to a physical-led regime under stress. Silver at hundreds would require a wholesale repricing of scarcity, either through extreme monetary debasement, a severe crisis of confidence in financial plumbing, a structural shortage in deliverable supply that persists, or some combination. That's not your base case. That's the tail. And the reason you pay attention to tails is not because you bet your life on them, but because tails change behavior in the present. When participants start believing the tail is plausible, even at low probability, they hedge differently, they hoard differently, they procure differently, they stop leasing metal, they stop selling forward, they demand more collateral, they pull liquidity. And that behavior can create the very tightness that makes the tail more plausible. Reflexivity, that's the word without the drama. And it's why silver can move like a trap door when the setup is right. But that's not the part that matters. And the part that matters is the next 1 to 2 weeks, because that's where your decisions happen. So here are the two scenarios, and you need both in your head at the same time. Scenario 1 is the controlled pullback and retest. In this scenario, silver continues to whip around, but gradually stabilizes. It retests key support zones, maybe even undercuts them briefly to run stops, then recovers. The curve stays relatively tight compared to normal, suggesting underlying demand for nearby metal persists, but not enough to trigger immediate panic. Gold stays stable, providing the macro floor. Volatility gradually compresses after spikes. This is the shakeout then build scenario. It's psychologically brutal because it makes you feel stupid for holding and stupid for selling. It's designed to grind down conviction and reduce participation. If this is the scenario, the confirmation is boring. Higher lows on the weekly structure, resilience after dips, and spreads that don't collapse. The invalidation is clean. A decisive break below the post-spike low zone that doesn't a T snap back, especially if gold breaks down too. Scenario 2 is the continuation squeeze and gap risk scenario. In this scenario, the market doesn't give everyone time. Silver reclaims the recent high zone quickly, often on a day where headlines are confusing and liquidity is thin. The curve tightens, nearby spreads jump, and the market starts behaving like it's paying up for immediacy. Options hedging accelerates forced buying. Shorts that leaned into the pullback get trapped, and the move becomes violent. This scenario comes with gap risk, meaning you don't get perfect entries and you don't get polite pullbacks. It's a jumpy, breathless tape. The confirmation is fast, reclaim and hold above the breakout zone, with spreads confirming and gold not collapsing. The warning is equally fast. If it pops and instantly fails, that's a bull trap designed to harvest momentum buyers. And that's where the real pressure starts. Now I want to put armor on you, because the market will try to manipulate you emotionally even if the thesis is correct. Here's how it does it. First, it uses volatility to make you doubt your process. A 6% down day feels like the end of the world when you're overexposed. A 6% up day feels like salvation and makes you chase. That's why position sizing is not a footnote. It is the difference between being able to hold a correct thesis and being forced out at the worst moment. Second, it uses headlines as a metronome. One day, it's silver bubble. On the next day, it's shortage. Then it's rate fears. Then it's China demand. The narrative changes faster than the physical market can. If you trade narratives, you will get chopped. Third, it uses false certainty. Influencers will tell you they know exactly what happens next. They don't. What you can know is structure, incentives, and invalidation. You can know what would change your mind. You can know what signals would confirm. And that's enough. But that's not the part that matters. The part that matters is the checklist you keep on your desk so you don't have to get played. Ask yourself this week, is gold holding its key support, or is it cracking? Is silver defending the post-spike base, or is it breaking and staying broken? Are nearby spreads tightening into strength or loosening into weakness? Is volatility compressing after spikes or staying elevated as price bleeds? Are there signs of physical friction like persistent premiums, procurement chatter, or unusual urgency signals, or is everything calming down? Are institutional flow proxies steady, or are they draining? And finally, are you positioned in a way that allows you to survive the path, not just predict the destination? Because the market will happily make you right and still bankrupt you emotionally or financially if you don't respect the path. Now, the last piece is the subtle part. Why this matters even if you don't believe in moonshot prices. Because silver isn't just a trade, it's a diagnostic for the broader system. When silver behaves normally, it's a commodity with leverage and mood swings. When silver behaves abnormally, when the curve and the physical layer start arguing with the screen price, it can be a symptom of something bigger. Supply chain stress. Currency, stress, trust stress, the kind of stress that shows up first in the small markets and then spreads outward. And if you own gold, you're already positioned for a world where trust is not free. Silver is the amplifier. It tells you how tight the system is. It tells you how quickly people can pivot from complacency to urgency. It tells you how fragile liquidity can become when everyone is leaning the same way. So here's my ask, and it's not begging it as a filter. If you're the kind of investor who wants mechanisms instead of slogans, if you'd rather be early with a checklist than late with a meme, keep your eyes on the curve, respect the post-spike base, and don't let a red day rewrite a thesis that hasn't been invalidated. And if you want to be around people who treat this like a discipline instead of a dopamine machine, you already know what to do. Stay sharp this week, because the next move in silver won't announce itself politely. And when it starts, it won't wait for consensus.